Hi everyone, let's take a look at problem 19-5, which involves a refunding analysis. Mullet Technologies is considering whether or not to refund $75 million 12% coupon 30-year bond, a 30-year bond issue that was sold 5 years ago, so we have 25 years left. It is amortizing $5 million of flotation costs on the 12% bonds over the issue's 30-year life. Now, the company's investment bankers have indicated that the company could sell a new 25-year bond at an interest rate of 10% in today's market. Now, neither they nor the management anticipate that interest rates will fall below 10% anytime soon, but there is a chance that the rates will increase. A call premium of 12% would be required to retire the old bonds, and flotation costs on the new issue would amount to $5 million. Now, the company's federal plus state tax rate is 40%, and the new bonds would be issued 1 month before the old bonds are called, with the proceeds being invested in short-term government securities, returning 6% annually during the interim period. Okay, let's take a look at Part A, which asks us to perform a complete bond refunding analysis and determine the bond refunding's net present value. Okay, our first step involves determining the investment outlay required to refund the issue. Now, since there's a lot of work involved, what I've done is gone ahead and staged this problem to save time for demo purposes. Okay, our first step would be to determine the call premium on the old issue, and how we would do that is we would take the $75 million of the old issue times 12% times 1 minus the tax rate, okay, and that will determine what the call premium on the old issue will be. Now I'll hit the F2 key so you can see how I did that. It's the $75 million times 12% times 1 minus the 40% combined federal and state tax rate. Okay, then we need to consider any new flotation costs. Now, one thing to note, it's $5 million is given in the problem, but flotation costs are not immediately expensed for tax purposes, so there's no after-tax calculation that goes into that number. Okay, next we need to consider the tax savings on the old flotation costs, and what we would do here is take the $5 million of the old flotation cost times the amortization. I think I wrote 25, 30, 30. That's how much we have left to amortize, times the tax rate. That's 25/30ths. Okay. Let me go ahead and hit the F2, and you'll see how I did that. It's essentially 5 million times the 25/30ths to show that we have 25 of 30 years left to amortize times the 40%. Okay. Now we enter that as a negative because we're trying to calculate the investment outlay, and that actually represents tax savings. Okay, the next item to consider is additional interest on the old issue. Okay, we would take 75 million times the 12%, the rate that was in effect on the bonds that are outstanding, times 1/12, since there's a 1 month period from the time we issue the new bonds till we retire or refund the old ones, right? Times 1/12 times 1 minus the tax rate. So here we take the 75 million times the old interest cost times 1/12 times 1 minus the tax rate. Okay. The next step we need to consider is the interest earned on the investments. Now, the problem indicates that while we have that 1 month's supply of the bonds, we'll put it in a investment vehicle that earns 6%. Okay, so what we would do here, I'll hit the F2 so you can see it. You'll take the 75 million times the 6% return you're going to earn times 1/12 to get us 1 month's worth of interest income, and again multiply it times 1 minus the company's tax rate. Alright, once we have all that, then we can calculate the total investment outlay. And here, of course, I'm just summing from above. So the first step in the refunding analysis tells us what's the total investment outlay, and we get an amount slightly less than $9 million. Okay, now I'm going to scroll up a little bit so we can work on flotation cost effects. Okay, the next thing we need to calculate would be the annual tax savings on the new flotation costs. Okay, now I do this maybe a little bit different than how the book presents it, but it gets us the same result. Let me show my work here. All right, the annual flotation expense is the 5 million times 1/25, right? We have 25 years, and we can only amortize the flotation costs over a 25-year straight line approach times our 40% tax rate. Okay, so the 5 million cost divided by 25 times 40% gets us $80,000 of flotation expense, and that's an annual tax savings because we're getting a tax shield on it. Okay, but we also are giving up the old flotation cost, which was 5 million. I'll hit the F2. 5 million times 1/30. It was a 30-year bond issue times 40%. Okay, so we give up about $67,000. So the net effect is we've got a positive tax shield on the flotation cost differential between the old bond and the new one. All right, then we need to determine the annual interest savings due to the refunding. Okay, so we take the annual interest on the old bond, which is $75 million, times the 12%, the rate in effect on the old bond, times 1 minus taxes. And again, I'll hit the F2, and you can see just straight multiplication. Okay, then our next calculation involves determining the annual interest on the new bond. Take the 75 million times the 10%, the new bond interest rate times 1 taxes, times 1 minus the effective tax rate, and what we wind up with is our net interest savings. And now, of course, that's just, since I've shown 1 as a negative, we'll just do a simple sum to compute the interest savings of $900,000. Okay, let me slide down a little bit. The next thing we need to do is determine the annual cash flows. Now all we'll do is add the tax shield from the flotation cost plus the net interest savings. And then we approach the last part of our problem, which is how do we determine the net present value of the refunding decision. Alright, I'm going to do this in 2 steps. I think it makes sense to lay it out that way. The first step is determine the present value of the annual cash flows for the next 25 years. Now we're going to use a 6% after-tax cost to do that. My reasoning here is take the 10%, the new interest rate in effect, minus the tax rate, okay, and we come up with a 6%. I'll show the formula. We take the 10% times 1 minus the tax rate to give us an after-tax NPV rate to consider. Take it for 25 years, and then consider the $913,000 of annual cash flows. And of course, you could use a calculator or even a present value interest factors table to come up with this same amount. And we come up with a present value of the annual cash flow savings from the bond reinvestment of $11.675 million. But of course, we have to back off the outlay of the 8958,333, the total investment outlay from above. Okay, and when we do that, what are we left with? Okay, let me slide up, and now we'll drop in. The net present value of the refunding decision, then, is the sum of that positive present value of the annual cash flows less the investment outlay from above. When we complete that, we come up with a net present value of $2,717,000 and some small change. Okay, that tells us this decision makes a lot of sense. Now let's slide up a little bit. B says, what factors would influence Mullet's decision to refund now rather than later? And you remember in the problem, there was some expectations about what will happen with interest rates. Okay, with the answer in front of us, let's go ahead and answer that. The company really needs to consider the likelihood of what will happen with interest rates to know whether it should take action now or later. If there's a high probability that the rates will increase, then acting now makes a lot of sense to refund the old issue. But the company also needs to consider if it may be harming its investors in the bonds and creating ill will in going ahead and doing the refunding. So if the company is highly dependent, say, on a small group of investors, it might want to not make them angry and avoid difficulty in obtaining financing. Now, if the bond issues are callable after a certain time, and the investors then expect them to call based on the change in interest rates, then there's less risk of offending the group. And so really those are the considerations that the company would need to take into consideration in making a decision whether to do the refunding now